Welcome to the Amazon Acquisitions Team presentation. Our team, Team 6, consisting of John Farron, Anna McKee, Haley Seaven, and me, John Griesenbeck, has worked tirelessly to assess Whole Foods Market, key competitors in the organic and natural foods retail sector to develop this proposal. In the slides to follow in the accompanying comprehensive report, you'll find our recommended strategy to acquire this impressive firm. We have no doubts that by the end of this presentation, the benefits of acquiring Whole Foods Markets will be apparent, supportive of a future acquisition, yielding increased profits for both party shareholders and overall greater value. Whole Foods Market has established a strong hold in the organic foods market, presenting a unique opportunity for economies of scale and our goal of strategic growth. Our core business model of direct sales to consumer is congruent with the Whole Foods Market business model and product line. Strong consumer demand for Whole Foods Market organic and environmentally sourced products will promote synergies commensurate with our direct-to-consumer platform and unparalleled global logistics network, congruent with our mission to be Earth's most customer-centric company. As of 2016, there were 118,812 traditional United States grocery retailers, accounting for approximately $648 billion. The 20 largest retailers made up 66.6% of the industry, totaling $515.3 billion. With over 500 mergers and acquisition deals in 2016 alone, the market continues to grow through consolidation and combined earning power as well as access to customers. Through this acquisition, we at Amazon expect to promote stronger growth, increased market power, and access to unique capabilities through diversification. In addition to the financial benefit of acquiring Whole Foods Market, there are other considerations that promise to substantially increase profits post-acquisition. Whole Foods Market would have immediate access to our brand, including home delivery services, negotiating power for wholesale purchasing, advanced technology, and web-based services. The combination of our research and development divisions will help to enhance access to potentially increase market share for both companies. Despite the challenge of competing with other top retailers such as Walmart and Kroger, we have determined these competitive threats within the grocery market industry do not have the same potential growth as would a properly integrated, strong business model between us and Whole Foods Market, given the competitive advantages and depth of our well-established structure.
Whole Foods Market was established in 1980 and is headquartered in Austin, Texas. Their success and continued growth can be attributed to many strategic mergers and acquisitions of smaller grocery retailers in conjunction with their focus on locally grown or produced food products. Whole Foods Market has over 86,000 employees and a strong organizational culture at all levels of the organization, and was voted one of Fortune 100's best companies to work for on multiple occasions. Their mission statement is to promote the vitality and well-being of all individuals by supplying the highest quality, most wholesome foods available. The organizational team culture is one that promotes high efficiency levels and incremental improvements in both individual and store performance. As of 2015, Whole Foods Market had over 13 million followers on their social media sites and has a reputation for providing high-quality organic and natural food products. As of 2016, they were the largest natural and organic supermarket in the United States. The Whole Foods business model is very simple, and local, regional, and national product selection is at its core. The competitive advantage that Whole Foods offers is primarily driven by their product lines of specialty, all-natural, and organic products that do not contain harmful preservatives and additives that are generally believed to be unhealthy to consume. This appeals to health-conscious individuals and those concerned with ecological sustainability. There are many strategic advantages of the Amazon Whole Foods acquisition, including access to our already existing best-in-class technology, home delivery programs, negotiating power, and heightened access to the development of new products. We will also combine our research and development sectors and utilize supply networks through efficiencies in warehousing and refrigeration, and create a hybrid of brick and mortar and online retailers. There are, however, competitive risks with this acquisition, such as new entrants diluting the market share of environmentally friendly and healthy products, business models that compete directly, and the different organizational cultures that could present challenges for the acquisition. These risks can be mitigated, however, through the depth of our operations and supply chains. Both Whole Foods Market and Amazon have a large customer base and popular, well-earned reputations. Both are large competitors, and by combining both organizations, we will soon reach a supergiant status, outranking and outperforming our current and future competitors.
Hi, this is John Farron, and we're going to be talking about the pro forma portfolio overview of Whole Foods Market. First, notice that all of the spreads in the following slides have 5 years of historical data from the 10-K filings of the firm and 5 years of forecasted data based on those filings. The first spread we're looking at is the revenue model, which uses stores in development, stores ending, and revenues per store to develop our total revenue forecast. Stores ending is based on stores in development and a ratio of 30.07%, which means that every year 30.07% of stores in construction can be expected to become operational the following year. Next, revenue per store has been averaged to $35 million per store based on the levels of $34 to $36 million in the previous 5 fiscal years. These two numbers multiplied together will give us our total revenue forecast. In fiscal year 2017, we see $16.610 billion in revenue, which is a 5.63% increase from fiscal year September 25th, 2016 of $15.724 billion. At the bottom of this spread, the other metrics we look at are total gross square foot in development, which is a function of the stores in development multiplied by the average size, and we also have derived revenues per square foot in dollars in the developing stores. In the next slide, we're looking at the income statement, again with 5 years of forecasted data. The sales data is derived directly from the revenue forecast. As you can see, the $16.610 billion is there in fiscal year 2017. Below that is cost of goods sold, which is $10,746 billion to achieve our gross profit of $5.863 billion. All the other expenses have been derived from value cost analysis based on common drivers such as sales, cost of goods sold, and net property, plant, and equipment. Cost of goods sold is an example of a driver pegged to sales because as sales increase, cost of goods sold must also increase. However, depreciation and amortization are based on net property, plant, and equipment from the previous year. After subtracting out other expenses, we achieve our operating income of $1,076 in fiscal year 2017. From there, we subtract out the interest expense, the investment and other income, and the provision for income taxes to achieve $644 in fiscal year 2017 net income. Next, we're going to look at the balance sheet, which we have incorporated 2 forecast plugs, one on each side of the equation. One in the liabilities section is the newly issued debt and obligations line item, and on the asset side we have excess cash line item used as a forecast plug. You'll notice that assets and liabilities and shareholders' equity do not equal each other until the forecasting plug has been factored in to the analysis. Once it has, the balance sheet balances. Most of these line items have been based on ratio analysis. However, if they have not been based on ratio analysis, they're either found through a trailing average, a 5-year average, or a 3-year average. At the bottom of the spread, we have metrics of working capital, the current ratio, and debt to total equity. While working capital has remained relatively constant, it does seem to be strong, indicating in conjunction with the current ratio that the firm is solvent and can take care of its current liabilities given its current assets. This is a strong indicator of value to us and a reason for us to want to acquire the firm because it means the firm on its own has been able to take care of its liabilities. On the long-term end of things, the total debt to total equity has been hovering around 1 times, indicating a 1-to-1 equal share of debt to equity in the capital structure of the firm. After the balance sheet, we're going to look at NOPLAT and free cash flow. And first, NOPLAT is simply the revenues minus the operating expenses and then minus the operating taxes. We have derived the operating taxes in the forecast period from an effective tax rate that is an average over the 5 previous fiscal year ending tax rates. NOPLAT, you'll notice, has a huge increase between 16 to 17 of 23.9%, indicating a strong environment for growth. And thereafter, we see growth between 5.27% and 7.64%, reaching 898 in fiscal year 2021. Below the spread is the free cash flow spread. In this spread, we're looking at again NOPLAT, with depreciation and amortization added back as they are non-cash expenses, and then from the gross cash flows of 17,115 in fiscal year 2017, we subtract out investments in working capital, capital expenditures, investments in intangibles and goodwill, increases or decreases in other operating assets, and gross investment. You'll notice that the investments in intangibles and goodwill have been held constant for forecasting purposes, as they are generally believed to not have much determination on the value of the firm. Finally, after netting out all of these line items, we achieve free cash flows of 16,847 in fiscal year 2017, or a 7.86% increase over the 2016 level. Finally, the last spread we're looking at is return on invested capital. This is an indication of a firm's ability to generate revenue based on the capital it has at its disposal. In fiscal year 2017, the rearranged balance sheet shows total operating assets, total operating current liabilities, operating working capital, invested capital, and invested capital including goodwill. From here, we include the other non-operating items and the debt. You'll notice at the bottom of the spread, the difference in the funds invested has zeroed out, indicating the balance sheet has properly balanced. At the very bottom of the spread, you'll notice the return on invested capital average, including goodwill, began at 19.18% in fiscal year 2013 and fell to 13.55% in fiscal year 2016. This indicates a loss in the ability of the firm to generate revenue on its invested capital. However, with the increased revenues from our revenue model and the synergies provided from the acquirement, we expect ROIC to jump back up to over 16% and climb steadily thereafter. Generally speaking, ROIC, as long as it's beyond the WACC, should generate value with growth. So with high growth and high ROIC, we suggest that this firm is very valuable and a good investment for Amazon.
Our proposal for structuring the transaction is as follows. We propose a conglomerate deal where we acquire Whole Foods' outstanding shares at a positive margin of $5 per share, creating minimal resistance to the deal. Whole Foods shares have a current market price of $35 per share. At this time, we plan to make no changes to the Whole Foods executive management team or board of directors. By not making these changes, we predict that the board will be open to finalizing the transaction timely and efficiently and will be pleased with the deal and their long-term stability and projected increased revenue. We feel they will also be sufficiently ready to integrate into our culture and operations. The offer price for this deal is projected to be $12.8 billion with a return on investment exceeding the premium of the offer. In conclusion, based on the data we have acquired, we recommend the acquisition of Whole Foods Market. Indicators show that this acquisition will increase profits, access to customers, and effectively diversify our portfolio. Even with major established competitors already in the niche market of whole foods and organics, Whole Foods Market emerged as a fierce competitor and continues to be a fierce competitor in the sphere. With more and more demand for local and sustainable products, this niche, part of a $600 billion industry, has and will continue to grow. By acquiring Whole Foods, we get ahead of the curve and we put ourselves in a position where we have a hybrid space where we can cater to both brick and mortar and online consumer preferences. Whole Foods joins our excellent reputation with an excellent reputation of their own and established long-term trust from their consumer base. We will now have access to their consumer base as well as other resources such as research and development, and access to their industry leaders and knowledgeable staff. We have projected a positive revenue outcome as well as other factors, including the combination of cultures and the diversification of being able to offer such a niche product from such a well-reputation provider. We have structured the deal to promote a positive working environment and success in satisfying the wants and demands of all included parties. In conclusion, this deal shows a projected favorable outcome, and we would like to move forward with this acquisition.